All right, that's awesome.
That's funky. So looks like we are live. Good day to all the Thrivers around the world. I hope you can hear us. Peter and I are super excited to host this live webinar, a first for us. We were just telling our guests here that this live webinar is now telecast live on 3 different platforms: LinkedIn, YouTube, Twitter, and that's amazing for us to see all of this technology working. Again, for the audience who's joining from various platforms, you should be able to comment or add questions on the chat window, and we should be able to see that. Anushka is manning our desk. She is going to keep us honest with all of the feedback that's coming in. Here's the topic of the day, and let's jump into it. Has SaaS lost its mojo? Sorry, I should have said GTM. And what can we do to get it back? So please join me in welcoming our experts. We have Dave Boyce and Rajan Sheth. Let's run a quick self-introduction across the table. And before we get started, maybe Dave, for the folks who don't know you, I know you and I, we have done a podcast that's going viral at this moment. But for the folks who still don't know you, could you share your background a little bit and how did you get in the world of the SaaS GTM? We will go from Dave to Rajan and then Peter, and then we'll take it from there. Dave,
sure.
Go ahead.
Yeah, that's great. And Rajan and I were comparing notes yesterday. I think we both have a lot of battle scars. The way we got here is by kind of scratching and clawing through a few eras of ups and downs and trying to figure out what works. I've personally helped build and sell 5 SaaS companies. And I started, I know I look very, very young, but it started before the word SaaS existed. I'm just kidding. My kids call me old all the time. But we were hosting applications in the cloud and calling it a application service provider back in kind of 1998, 1999, and then the word SaaS came about, and then we went through all these eras. But kind of building and selling, and as you said, Guru, like the doers, the people who do stuff. There's thinkers and there's doers. Like, in order to really earn the lessons, you got to roll your sleeves up and get after it. And so, building and selling 5 SaaS companies, a couple of them we got away with our life. A couple of them we did actually pretty well. And now I'm on the board of Forrester Research, and I'm the chairman at Winning by Design, which spends full time on SaaS GTM.
Dave, you're right. There's you learn a lot by doing, and you get battle scars by doing. So you can see
There you go.
my hand after typing so much. Thank you, Dave, for your introduction. You've been very modest, and today it's a little bit about how you got into the space, and you've been a master of GTM at the various companies that you've been advising and leading. So maybe Rajan, please go ahead.
Yeah, happy to share. First of all, super excited to be here and chatting with Dave yesterday. I think we have such different opinions on some things from SaaS and AI. So I'm super excited about this conversation. More of a debate, I would say. You're gonna be on a ride. But my introduction. So I was a developer in my past life. Soon realized that I'm never going to be a great developer. Looking at my wife, she's so amazing in terms of building things. So I decided I should pivot. And at that point, marketing was going under a transition from just being a spray and pray to more digital, as well as, and again, that ages me quite a lot. But I made that transition into marketing and growth, and particularly focused in on like leveraging how it can be more focused on data, technology, and the creative aspect of it. And back then, PLG was not a term. We were doing growth things. And those are the battle scars from not even knowing like what is PLG, what is self-service, how do you target developers, what is developer marketing. We were building the playbook while it was being written with newer products that are coming out to target those. So started my transition in marketing and growth back then, doing bottoms up, PLG, and latest I've been focused on a lot of these PLG bottoms up and tops down companies. So I used to be running marketing and growth for Heroku, one of the developer platforms, and joined when they were like 50 million, and we grew to 500 million. Most of that was through bottoms up, and it's a huge business for us, for Salesforce. And then I joined. I was trying to figure out what I do with my career, and as an engineer, I went back to deciding what are the pieces in the market. Like DevOps was very hot back then when I was there. What's the new thing? And I was honing into AI ML, and I got introduced to a couple of CEOs who were building AI models back then. And this was before ChatGPT times, and no one knew what large language models were, including myself. And then I took a bet. I ran the marketing for Cohere, one of the leading enterprise LLM provider, and I was the first marketer there before ChatGPT times. Built up their entire bottoms up, tops down enterprise messaging, positioning, pivoted to partner motion very quickly, and then 2 years we were growing pretty fast. And then I was talking to so many different AI founders. It's like there's such amazing background, super smart researchers, want to build something really cool. They don't know how to go to market. And the first thing they need to know is like, now, how do you differentiate, position yourself in the market? What's going to get them traction and growth? So I decided to leave my full-time job, and then I became a general partner for Hypergrowth, where we advise early, mid-stage, and late-stage companies on marketing, growth, and sales. And particularly for myself, I am focused on running an AI go-to-market accelerator. And we help companies as a fractional CMO, as an advisor, and an executive to partner with you and the founders and the marketing and the growth teams. So right now I'm advising Together AI as a fractional CMO. They are an infrastructure space providing inference platform as well as the full stack solution for enterprise AI.
Thank you, Rajan. I mean, you omitted many things, that I loved about our conversation before, like Cohere and so on and so forth. So to our audience, I'm sure that you might realize that Rajan and Dave are almost on the opposite end of the spectrum, and we are Peter and I, we are very excited to have both of them here. We're looking to have these two heads, butt together. Dave believes in more moderation, as far as I know, whereas Rajan represents a swath of these AI companies who would like grow at all costs, and that's the way forward. Before we jump into the topic, I would like to bring in Peter. Peter, my co-host, and something really wonderful I love about him. He doesn't call it as product-led growth. It's called Peter-led growth, and that's his website as well. Peter, do you want to introduce yourself a little bit?
I found something positive in a rhyming name finally, but yeah, there we go. I got some background on me. I'm a serial entrepreneur. I've got my failures and successful exits like most of us do. I've worked inside of organizations. I've worked as a fractional leader, and I've worked as a third-party consultant for nearly 2 decades. Very been there, done that. And I support CEOs and teams with holistic consulting focused on go-to-market strategies, sustainable growth, social impact, and organizational stability. This is for startups, scale-ups that are pivoting, and scale-ups that are introducing product or even have plateaued. My work uniform is a thinking cap and rolled up sleeves and a coach's whistle. Worked in automotive through SaaS, B2B SaaS. I'm the host of Pitch Slap, which is a GTM podcast, Hey Good Chat, which is a social impact podcast, frequent guest on GTM games for Hard Skill Exchange, and thanks, Uraj, for adding this new hat of host and panel moderator. If you're interested in getting a hold of me or seeing some of the media where I express a very spicy opinion, go to peterledgrowth.com. Hey, y'all.
Yeah.
There you go. There you
Raced
go.
through that. That wasn't even my normal elevator. It's too
So
bright
thank you,
out and there's
Peter.
no
Thank you.
cocktails. I don't have to go through it.
Yeah. So Peter and I, we've connected several times, and I've been fascinated by the amount of, the web of, or the labyrinth of things that he's into. I'm glad to have him as my, co-host today. So with that said, let's jump right into the topic today. Maybe we'll start off with the first question to Dave. Dave, you and I, we've touched upon a similar topic, a podcast on has SaaS losses GTM. Maybe could you educate the audience a little bit about, and maybe take a moment on how did we get here? What's happening in the SaaS GTM space? Why is growth stalling? Why is spend happen? And I know that you're part of the firm which also does a lot of that research. So maybe if you want to take the audience through that journey, maybe in the next couple of minutes. Go ahead.
Yeah, great. So, I mean, the first thing is, what is happening, and then why is it happening? In late 2021, we and I think the very first signals of this were DocuSign. Their stock was devalued when they gave just some little signals of weakness in their kind of forward-looking statements on their earnings call after Q3 2001, and their stock was devalued by a third. Oh my gosh, is that like what's happening? Then 2002 happens, and we see a lot of weakness start happening. This is in public companies. And then 2002 was not good, right? Like we got Silicon Valley Bank failing. We've got VCs locking up their kind of investment coffers. Now we've got private companies who are struggling to get the next round of funding to fund the next phase of growth. And the public markets, it's kind of the great SaaS crash. You can literally look at it on a graph and you can see valuations running up for a SaaS index and then crashing. So what is happening? If you dig in one click below that, growth rates cut in half across all SaaS companies. There's 72 public SaaS companies right now. We've looked at it for private companies, but we don't have a reliable kind of comprehensive index that wouldn't out people. But it's happening in private and public. Growth rates cut in half. Meanwhile, for the growth we are getting, we're paying more. So for every net new dollar of ARR, of which there are fewer, we're paying over $2 on average to get $1 of net new ARR. And if you look at and we've got all this data, I don't know if it probably doesn't make sense to pull it up here, but we have all this data. But if you look at kind of the public companies, you can go name by name by name. Who's paying $1? Who's paying $2? Who's paying $3? Who's paying $4 for each incremental dollar of ARR? So that's so yes, growth is slowing. Yes, we are paying more for what we are getting. And then you've got to click in and say, well, what happened? Like, is this a product market fit problem? Like the products we're selling are no longer kind of in favor? It would be hard to paint with that broad of a brush for the entire SaaS industry. Is it a go-to-market fit problem? Meaning the way that we've been bringing these products to market is just not working anymore? Well, if you think about your own life, like, I don't know, like, are you opening more emails or fewer emails? Are you answering more phone calls or fewer phone calls? There might be a go-to-market fit problem. Like the way we were bringing these products to market might not be working as well as it used to work. we had built these whole industrial complexes around kind of high velocity prospecting, kind of the predictable revenue model of just hit the phones, hit the email, go, 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 accelerate it through outreach and sales loft, go, go, go. That may not be working as much anymore. So now we got to click in one more level and just figure out, well, which pieces are working, which pieces aren't working. I think that's the conversation we're going to talk about today. And how do we get back to a model of sustainable growth?
Okay, Dave, maybe let me add a quick question on that front. You mentioned that the era of growth at all costs, which I think you've coined that term. I think you call it as GAAP or GAC.
Yes.
And I've seen you and your company posting it many times on the social media. So growth at all costs. So is the era still around growth at all costs, at least from your research? Do you see that the sales and marketing spend and the spend associated to getting new customers or net revenue, is that petering out, or is that constantly increasing as time progresses? What do you see out there? And
It is.
after that, we will get into Rajan's.
Yeah, for sure.
Go ahead.
So as an industry, both, as a SaaS industry in public and private companies, growth at all costs is over. Why? Because it loses money. Okay, fine. Well, then why did it work 3 years ago? Oh, because investors would pay us to lose money.
There was money to lose.
Yeah, investors would actually give us more money to lose. Investors said, like, hey, give me a triple, double, and I'll pay any price.
Okay, so you keep coining terms on this, and one of the ones you threw out was go-to-market fit. Like
yes.
Mark Andreessen back in, what was it, 07, saying product market fit?
Yes.
Did anyone ever have go-to-market fit, or was it just that cash was so bountiful and liquid that we could pull that off?
Ooh,
I might kick that over to Raj as
that's a good question.
resident high spender. What do you think about that, bud?
Yeah, I think there are different phases in the industry life cycle that we see, right? During like few years ago, it was like all B2B SaaS, like growth at all cost. Now, primarily the VC funding is going into AI. Unless you are building something which is fundamentally changing the way people use products with AI, it's very difficult out there to get funding. Also, the existing companies, like, they want to be more efficient, and as Dave mentioned, like, it's not a growth at all costs for traditional B2B SaaS. But I think it's very different. Like, we're seeing this wave in AI. Like, just last year, like, more than 400 AI companies got funded, and 21 billion just went into 2023, and that was just getting started. This year is even more, right? And most of it are early stage, and they continue to raise more and more money every 6 months, or every even lesser to some extent. Though all the companies, they don't have the revenue multiples that you look for a traditional B2B SaaS. It is all about getting the market share, getting more users to use the platform, getting adoption, getting the POCs, getting into enterprises. But it is also more about getting that hype, because that's going to continue to fund the adoption in this crowded space. So what I'm seeing in this AI wave is that there are a lot of companies emerging across the stack, right? From applications to infrastructure to foundational models to companies building compute or offering compute to these high spender AI companies who are coming up. So everyone is getting enough in terms of the capital to spend. And the capital spend comes in many different ways, right? For example, for compute or for foundational model or infrastructure companies, like, the biggest spend on the line item is for H100s or NVIDIA compute or any other compute that they need to either train models or serve those models. The second highest is mainly the employees, because the researchers are expensive, so they need more funding. And then I think the marketing and the sales expense come in. Like, even then, marketing and sales expenses are much higher, because there's a high demand from these investors to get the market share and stand out in the market. So I'm seeing like very different. Whenever I talk to CEOs in the traditional B2B SaaS companies, they're all about efficiencies. And whenever I talk to the CEOs on the AI side, It is about like, how can we be the next Cognition, and how can we build something like Devin? How can we be some like Perplexity? How can we be something like Together AI? And that's exactly what's happening. Like everyone wants to capture the market share and be the top brand out there.
Okay, so I want to get spicy here. Hopefully, I can cause some dissent. You had mentioned hype, and traditionally, and this is me having an opinion. This is not like law. You two are the experts in fact. I'm the expert in gut. Hype has traditionally been around funding. Everybody gets in the news because they got money. But now you're talking about a business market fit. As someone that's been a consistent bootstrapper, as someone that's hosting a webinar for a person that's only going to bootstrap, he's swearing by it. The popularity that comes from funding, that hype, isn't going to exist. Outside of AI, there's not a lot of investment. There's not a lot of like newsworthy investment. So now it's what? When we're looking for that brand market fit, since we're going to keep throwing out these new acronyms to rule the world with, what do we need to do as entrepreneurs, as founders, as people in organizations that are trying to lift that organization into public visibility beyond traditional go-to-market strategy?
Yeah, so I think I can take that. So there are multiple ways, right? Like funding is not the only way we create hype. Like traditionally, it was just like, oh, you raised a round, do a press release, done with it, you got a hype about it, done, right? I think what's happening with AI is that none of the products are ready, or even like the products are continuing to evolve. So whatever you have in the market is going to be obsolete within 6 months, right? So you have to continuously generate that hype and continuously innovate. But you cannot wait for the product to be ready and then go out to the market. So what is happening now in terms of generating hype is like more beyond the product. Right now, everyone is thinking beyond the product. So what is happening is, how do you sell and market your vision? How do you establish a brand, not just for your product, but also for your founders? Because these founders come from a very research heavy background and very prominent in their field. So how do you use that to create more hype, right? And then you find some unusual levers. For example, like what is the conversation that is happening in the market? Like AI policy is hot, like with elections coming in, like how do you insert yourself in that conversation? Like White House is doing that. They want to get ahead of it. Why can't you, right? So how do you get yourself inserted into some of these market conversations to continue the hype and momentum for you? So that's how I would think about like the hype is like funding is just one aspect of it that you use to give and attest your positioning in the market overall and what you're doing. But you have to constantly do that with newer levers. For example, there's a new bill coming up in California about the AI policy, siphoning off the AI innovation. Like, how do you insert yourself in that, right? So you have to constantly be aware of what's happening in the market and tag on to that to continue to generate hype.
Yeah.
So in the world in general,
Go ahead, Peter.
like recently, there's a company that focuses on stickers that made the news because of complete misfire on political, not even political alignment, just a political statement about, everybody happy, everybody get along, and then let's throw a sales message inside of it. So I hear you on pursuing the political angle, but what really rang to me, and this goes outside of AI, you had talked about celebrity engineers, people that are celebrities in their space. And we've all seen it many times before. We've seen like the rise of the developer in the past 5 or 10 years, where that's a market everybody wants to hit. And they want to do integrated product and they want to do APIs and all these items that are for developers. If you look at RISC-V, they're finally up there. They're competing with AMD and Intel. Open source is really kicking butt right now. And I guess I'm going to throw this to Dave, if he wants it. When we're looking at
Peter.
when we're looking at SaaS at large, beyond AI, and going back to where do we find the hype? Is it in staff celebrity? Is it in like a personal brand? Is it in developing ABM campaigns? What is since we're on the low cost side, what's your low cost all in approach to getting that hype?
So first of all, yes, I want to address that, but Rajan, I love I love your perspective. I know we're supposed to be fighting.
No.
But it's fine. But that multi-dimensional kind of let me fight on every single front to establish myself in a frothy market. I just want to tell a quick story. In 1999, it's before a lot of people on this call are born. The internet is like going crazy, right? Like Yahoo's been around for a couple of years. The internet is going crazy. I'm sitting in a high-rise building. We just took money from a venture capitalist. We built a thing called buyiq.com. It's going to compete with epinions.com. And, when we're able to raise basically as much money as we want, we're sitting in this conference room of our venture capitalist office, and floating by the window comes a blimp. And on the blimp, it says monster.com. Okay.
Yeah.
So it is frothy market. Everybody's looking to get attention. We've got pets.com, we got Chemdex, we've got monster.com. We got Yahoo. Everybody's looking to get eyeballs. And everyone said, hey, it's not about profit right now. It's not even about revenue right now. It's about eyeballs. We're trying to get out in front. I get it. And when you're playing that game, which I think that's where AI is right now, that's what you're competing for everything. And so back to your question, Peter, you're competing for the best dev talent. You're competing for the best, the smartest investor money, not necessarily the most, but the smartest investor money. You're competing with partnerships. You're trying to get on the inside track so you can get NVIDIA compute, which is really hard to get, or you're trying to get it through a channel or whatever. You're competing on every front. You're trying to get these pilots, like you said, Raj, on POCs and in enterprise companies. All right. So what percentage of us are in the AI market? Whoever should play that game. Like, you should absolutely play the game. It's probably 1%, 2%, 3% that are getting like 80% of the investment money right now. But the other 98% of the market, back to your question, Peter, we can't play that game. Like, we can't go buy a monster.com blimp. We can't go like put a giant block of ice on the, in front of Stripe's, invest or eBay's or PayPal's developer conference and let it melt and say PayPal freezes your money. These are gimmicks and kind of hype things that we did when everything was up and to the right. But right now, for 98% of us, it is not an up and to the right. It is a battle. And so what we have to do, if you want, like when I talk to CEOs, if you want to stay in control of your company, you got to be in control of your company. Like, the money that you spend has got to produce returns, because there's no one waiting to hand you more money. So you know who you got to get the money from? Customers. And you know what? You're going to absolutely you know what the 0% risk in your business is? Here's a reality that has 0% variability. You will write paychecks to your employees. 100%. Will money come back? We don't know. That's the whole mystery of GTM. I will write the checks. Will I get the money back? And when I know that venture is not waiting to hand me money, then I have to go play this game with customers. I got to be really efficient. I got to know that the money I'm spending on GTM is actually going to return from customers.
Yeah.
Okay, so number one, Raj, your opinion has been super popular in all the comments. So great on that.
No, I can add, like, I think Dave agreed with me once. So I'm going to give one more point, and I agree with Dave. I think he's right. I think not everyone has the money. And I think it's sometimes true even for AI companies before they find product market fit. So I'll give you an example. So at Cohere, right? We were able to compete with OpenAI and Anthropic, some of the biggest players, raising billions of dollars every month, I guess, at that point. Right. And our positioning was very different, right? How do you differentiate yourself in the market becomes really more important. You're not just competing with them, but now you have a different position in the market. You're going after enterprises. You have your different value props. And with that, I think there's another angle. Like Cohere, I spend $0 on brand marketing, right? And we have to find these unusual levers. For example, you have, as a leader, to take few big bets. Like, one is, the big bet that we took was, when I joined, is like, the AI market, even if it goes really big, like what had happened, we didn't estimate that, there's going to be a real shortage of developers with AI skills to build and implement AI technology. So early on, even before ChatGPT, we invested in something called as LLM University, or Large Language Model University, which drove like more than 40% of our traffic at the towards the end, right? So like placing those strategic long-term bets becomes really more impactful, even for B2B SaaS now, to identify where the market is going. Another example was we were able to get into some of the conversations like organically. Like it's not about just the hype, but like how are you contributing to those conversations? For example, if you remember, there was a conversation going on like several months ago around the AI doomerism. Like AI is going to end the whole existence, and there are so many big uh, companies as well as more prominent people signing that bill. Like now you have to find an angle of what you believe in as a company. Like, do you believe that you want to join them, or you have your own point of view on how do you want to relate that to your enterprise positioning? So the angle that we took was we don't believe that AI is going to end the world, but we need to first focus on the more immediate risk around misinformation, around bias that AI is creating, and that's solving the real problem. And that got us like a really big angle and got us a new positioning in the market. So you can be more creative without spending a lot of money sometimes. Like we never hired a blip, we never did a conference at Cohere when I was there. I think some of that like may still work, but I think we found like really cool like smaller angles for us to continue to carve out that position.
So that's Guraj, I promise I'm going to let you be a co-host on this. I'm not just going to stand on the box
No. Go ahead.
and say everything, but we have to mark that 31-minute point, because you spoke to category creation is one of the most expensive things anybody can do. And there are a lot of people out there trying to build a category around AI right now, as well as all the little branches that come off of it. And you made a statement basically around community and contributing and educating, which most organizations historically have never done at all. You know, Dave's going to wax poetic about the late 90s on this, but have we seen this amount of category development in SaaS, or really any industry? I'm not talking like, don't go back to Henry Ford, but have we seen any industry that has so many startups tied to it, that has so many different branches of what they're trying to accomplish in such a new terminology that frankly is scary? Even if it's not ending the world, it's changing the world, and most people hate change, or they're scared of it. So have we done this before? Is there anything to model after?
So yes, in the late 90s, we had the .com build, and it busted in 2002. If you look at that shape and you overlay the shape of SaaS, this is just kind of public market valuation, aggregate public market valuation. You look at the shape of SaaS's run up and then crash, it looks exactly the same. Like they look exactly the same. SaaS started ramping up in 2012. It was really before that, but if you start looking at the index of 2012 and then crashing, kind of, landing in 2023. I don't think either of those is as big as AI, honestly. I think AI is indeed in category creation mode, and I think it's at least as big as the internet, in the .com bubble. That's what I think. So,
does this speak to that red line that you were telling us about before?
No, I'd like to speak to that, but that red line is the aftermath of the crash. So, like, here we are, like, valuation, money flowing, category creation, growth at all costs, and then the music stops, and if you are a category leader or a category not leader, it doesn't matter. Investor money is no longer available to fuel unprofitable growth. Now you got to retool. Now you got to back up and say, okay, what's working, what's not working, and that's where we find ourselves as SaaS, and that's where kind of we get to that red line chart, which is doing what to try to be, profitable and in their go-to-market. All spaces except for the one Rajan is in, and maybe a couple of things in, biotech and other kind of category creation spaces, kind of right now need to make money. They kind of got to be efficient and go-to-market. And so I wish I were back in the late 90s, or I wish I were on the AI bandwagon like you are, Rajan. It's really fun. I have three kids who are AI developers, three of my kids. built, using LLMs also before ChatGPT was out, and it's super fun to watch them and live vicariously. I know it's a hype cycle. I know it's amazing, and people who win are going to win big, and people who end up without a seat are going to have to retool. That's just the way it goes.
All right. Well,
that's called as learning. If you don't win, you learn.
So I'm going to take the path back to your. I'm going to take a path to get to your red line.
Okay, great.
Because, we talked about funding and funding falling away, and even when it comes to AI, biotechnology, these civil defense, any of these technologies that people are still chasing and investing in. When I was doing that kind of work as a salesperson, we used to sell the journey. It was basically we were taking a loan out from customers. We were selling them 80% of the product for 100% of the price, with the promise that by the time your contract
you did
ends,
that, Peter?
Oh, if there's a salesperson watching that has not been forced to do this, hop in the chat and I'll send you a swag box from some of the crap behind me. I guess we just moved to PG with my usage of crap. Anyway, the International Bank of Customer seems to be what everybody made a run on and what caused these crashes. Are we doing that again with the type of growth we're doing? Are we screwing up packaging and pricing? Are we screwing up how we approach growth? Are we not understand? It seems like everybody's doing fail forward, but they're doing it wrong. And they're trying to sell something before they even have MVP. Like what's going on? Did that open up enough of a window for you to?
So we did it. If you want to, I don't know if you loaded that other graph with the two overlaid kind of crashes, the SaaS crash and the .com crash. But we did this. In those run-ups, we did that. We sold this what we're looking at right now is current data. And that green line represents if my sales and marketing budget is 100% of net new ARR for any given period. These are public companies. The red line is if my sales and marketing budget is 200% of net new ARR for any given period. Meaning I spend $1 for $1 or I spend $2 for $1. And then you can see stuff that's above that that red line, I think the top line, above 200%, some companies are spending 3, 4, 5. Well, that used to work. So here I am spending, I'm at green, less than $1 to get $1 net new dollar of ARR growth. I'm at red, spending $2 for $1 new dollar of ARR growth. And the other thing is look at the trends. These are trailing 5 quarters. So spending more and more and more and more, spending more and more and more and more, spending more and more and more and more. And pretty soon I bust through that 200%. And then some of these companies are still pursuing tactics that still are costing a lot of money, but are not producing growth. And so I'm spending $3 or $4. And you can see some now up at $5 for $1 of ARR growth. So I think, Peter, the tactics of before the crash are not the tactics that we need to pursue right now. If you stubbornly hold on to what used to work and just wait for it to come back to normal, it's not going to happen. And you see companies trying to do that. Well, let me just do more and we'll go back to normal. Let me do more of what I know it works. It's worked my whole career. I know it works. Let's just do it. Not necessarily. It may not work now. Email may not work now. Outbound may not work now. Cadences may not work now. Or if they do, they're going to work in a different way. Maybe I got to look at some lower cost or some inbound or some opt-in or some self-service. Maybe I got to blend my GTM. Maybe I don't need to pay a salesperson and an SE and a value engineer and an RVP and a CRO on every deal. If I'm not collecting $1 million for a deal, how do I pay those 5 salaries? Maybe I restructure. So I think we're in the time right now where we're rethinking that as SaaS.
You just threw out a massive, it depends. That's fun, but at least you threw out some possible solutions. If you saw your company name go by on that ticker, there's a book coming out and there's a few people here that are available for consulting to help you get, not doing that red line. Anyway. Rajan,
maybe let me jump in.
How do you feel about that?
Yeah, so maybe let me jump into ask a leading question around this, right? So now that Dave, you mentioned public companies, cannot continue doing the same thing as what they've been doing earlier, right? So billboards, blips, all the things we mentioned about SDRs, there's a sizable SDR team, GTM automations, cadences, various outbound sequences, call it email marketing, trade shows. I mean, if we add all of that up, I think it was David Spitz or somebody else who mentioned that it's about 50 to 56% of the entire spend is primarily around GTM, right? So the entire spend is GTM. With the new wave of AI coming in, so there's R&D budgets that are starting to go big. The cloud spend is starting to go bigger and bigger, right? So which means that the R&D, the people budget outside of the S&M budget is now starting to balloon to about 70 to 80%. So you're absolutely right, which means that you can't continue to do what what used to work earlier with inbounds and outbounds and all of that, with 50-60% of the budget being allocated for GTM. Now with the AI, that's reducing because you have to create the new category. All the PR campaigns that you might need to do, you might need to be on, let's say, some kind of cloud computing deal, some kind of NVIDIA deal, partnership, and all of that. So if we take out the AI companies aside, right, that's still, about maybe 8 to 10% of the new funding that's coming in, which is taking the lion's share of the funding, almost about 70 to 80% of the funding that's going to them. What should the rest of the companies do outside of adding AI, right? I'm sure they're figuring out how to add AI, but how can they manage their GTM to be still effective, keep the costs low, right, and still being able to be relevant in the marketplace? Is product innovation the right thing for them? Going PLG or self-service, still relevant, or that era has passed? Go a lot more on S&M, get your SDRs, get your partnerships, and go a lot more on the sales and marketing spend, or have more and more of the balance, the balancing between the self-serve, the PLG, the SLG, and the partnerships to be coming together. And this is primarily for the B2B companies who are not completely invested into AI. What do you guys think?
I have an opinion, and you asked about the rest of the companies, that that don't have the VC money spending or flowing. So, if you didn't feel well and you went to the doctor, what's the first thing that the doctor would do? She would take your pulse. She would take your blood pressure. She might do a blood workup. She might get you on the scale. Like, we're going to figure out your body mass, and we're just going to figure out what's going on, a diagnostic, right? Like, let me just figure out what's going on if you don't feel well. That's, I think, what we need to do if we don't feel well right now. If we're one of those 70% or 90% of the companies that are getting none of the VC funding or public market attention, let's go figure out what's going on. And to do that, what I would do, you can do that GTM efficiency metric that you pulled up, Peter, which is what percentage of net new ARR do I spend total sales and marketing? You can do that on a per GTM basis. So I can do that for my PLG motion. I can do that for my inbound motion. I can do that for my outbound motion. I can do that for my enterprise motion. Depending on how many GTMs I have in my business, I can look at what percentage of net new ARR do I spend on sales and marketing, and I can compare myself. Now I can see which lines of business are earning for the spend on GTM and which ones are not. And then I can start clicking in and saying, all right, I got 2 healthy lines of business. I got 2 unhealthy lines of business. And now I'm starting to kind of pull that thread. If I've got an unhealthy line of business, I am indeed going to have to click into something called unit economics. Like, for every dollar I spend, what do I get back? Like, I'm going to have to look at it. Like, I'm going to have to get nerdy. Yeah, go ahead.
Let me ask a question to you, Dave. How long is that cycle to get that money back? Like, when do you expect? Is it like over a period of 2 years, 3 years? Because that's what we are seeing in AI, right? Some of the investments that are being made is like considering that they're gonna continue to spend and scale for the next couple of years, and you'll get those revenue back. So how are you thinking about it, or seeing from like the B2B SaaS perspective?
It's a great question. So when you do these unit economics, a lot of times you say, hey, yeah, I'll spend $1 now and I'll only get 50 cents back next year. But guess what? I'll get 50 cents the following year, and then I'll get 50 cents the following year. And pretty soon I'm going to have a positive return. So how long of a window do you give yourself to make your money back? That's a big question. My opinion is it should never be more than 5 years. I think anything further than
5.
Yeah.
That's long.
That's all.
Well,
Yeah.
that's the very longest. Because
Yeah.
think about like what happens 6 years from now. That's fiction. Like the competitive set 6 years is completely different than today. The market is completely different. So if you're selling a subscription today that you think is still going to be around in 6 years, and you believe it so much that you're going to spend money right now for $1 and you get 6 years, no, forget it. I actually think 2 or 3 years is even smarter, Rajan. Like if I could pay myself back, I like paying myself back in 1 year, spend $1 to get $1. Okay. And then everything after that is gravy. But if you could talk yourself into 2 years, and that kind of corresponds to that chart of 200%, but can you talk yourself into 3? Can you talk yourself into 4? I think we're entering the world of fiction. And during the run-up, we did that. We said, oh, we got a lifetime value calculate, we got a 92% net retention gross retention. And therefore we're going to have customers for 11 years. So therefore we can spend a lot of money to acquire those customers. I just think that's fiction.
Yeah, I'm pulling up Jason Lemkin's metrics on CAC and the ROI on the CAC. This is what he has posted some time back. For B2B2C companies, it's almost about 3 to 4 quarters. That's about a year. So which means that you can actually go experiment with your GTM motions much faster, with B2B2C. These are like the Canvas or the Miros and anyone who's marketing to the business, but the buyers and the users of that are the employees of them. For B2B companies, it is about between closer to 24 to 36 months. And for AI, it seems to be about 3 years. So Rajan, what you're seeing on the other side of the spectrum, on the AI side, is the R&D investments and the CAC investments, will lead up to 3 to 4 years down the line, which is why you need a lot more funding, right, to be able to go sustain yourself. But 3 to 4 years later, looks like if you don't sustain yourself, you might lose up all the funding.
I think that's
So
fair, right?
I
think that's fair. I think that's what we are seeing, right? Because if you think about how VCs invest money, they're not investing money saying that, oh, you're going to disrupt a category and give me a return in a year or 2, right? So it's always going to be in a long-term horizon cycle. That's why you're seeing these valuations, which are skyrocketing, because the future potential of what they're going to achieve. And the R&D cost right now is going to be really, really heavy, because 2 things, as I said before, like compute is very expensive. That's like the biggest line item in terms of the burn rate. The second is the researchers. These researchers are few, and the good ones are even rare, who are really going to change the trajectory of your company. And they are really, really expensive. And it's very difficult to get them. So you're going to spend a lot on them. The third part that delays the revenue is that enterprises are still figuring it out on how to go to production with their generative AI strategy. And that's delaying. They're doing a lot of POCs. They are scaling slowly, right? Because they want to make sure that existing products doesn't break. They want to make sure that the features that they're providing are good and valuable for the customers. And they're even taking time to implement some of those. So the revenue is delayed, compounded with the heavy investment on CapEx that needs to be made now. You will see like some of those returns would scale like even further than a couple of years, the spending that's happening right now, right? But if you look at some of the good companies, the revenues are scaling, like doubling every quarter. And that's a good signal for VCs to even pour more and more money into that.
Do we see that, Rajan, across self-service and sales-led?
I think I'm seeing like now, as you mentioned before, they're all going from all different fronts, whether it's a bottom self-service, whether it's top-down sales, whether it's like partner motion. It's everything together, because I think it's a land grab time right now. Everyone is building partnerships, including the cloud providers. No one wants to get left out. So it's happening from every angle. And I think the sales team like are growing pretty fast, with an expectation that they're going to have more and more to go and close.
I'm going to pull some audience questions up now that we're in the last 10 minutes or so. Leanne posed something pretty interesting, Dave. This goes back to the efficient spending. And from what I'm interpreting here is that we're at risk if employees are the only ways that we cut cost, because then we're getting into cheaper, underexperienced people that are wearing many hats, and they're Google searching how to do their job. I'm old. They're using AI prompts to tell them how to do their job. Where do we actually make cuts to be efficient? This is for anybody on the floor.
Yeah, I couldn't agree more, Leanne. Absolutely. Like we tried, like if you look at I can't remember what it's called, like techlayoffs.com or something, you can see like a wave of layoffs in 2022, even continuing into 2023. Everybody desperate to just get cost down to where we can sustain it. But you're not going to cut your way to greatness, not in numbers of people or quality of people. You're not. So we actually have to re-architect processes. Like we actually have to think about how we're going to market. And the stuff that used to work may not work now. So we got to turn into kind of lean manufacturing engineers and go into kind of continuous improvement mode and closed loop data mode, where we actually investigate these processes and make every process fight for its own existence. If I get the process right, then I can actually go hire the right humans to go run a good process that actually delivers. And that human could be expensive or cheap. Like, I don't know, like depends on what the process is. But it's process first, and then, and then either automation or human second, depending on what's called for.
Yeah, couldn't agree more. I think a lot of these companies, like I think you need to evolve what you do, and I think as Peter mentioned, cut your way to greatness. Like you need to constantly evolve of like how you are adding value, because I see like a lot of these companies would say that they're laying off because of efficiencies, but they're actually automating a lot of those things in the background. And the good people are continuing to evolve their skill sets and be more productive. And that's the benefit of using AI, not just from marketing to AI companies, but also using AI in your day-to-day life, because only then you'll be able to continue to grow as well as have a meaningful and leverage impact out there.
I love this. I got to be a culture vulture, Dave. I got to own your cut your way to greatness now. So you're officially swagger jacked on this webinar. There's a question that came in from a YouTube audience member around specific GTM strategies for generative AI startups, and how can generative AI leverage PLG? We keep mentioning it, but we don't mention a detail. Let's double click.
Yeah, so two things. One, PLG, what's happening now is at the end of the day, like even if you go tops down, enterprise heavy sales motion or enterprise heavy or decision maker audience, right? At the end of the day, what happens is that the CEO is going to involve their head of AI ML and their AI team to start using your products. If you're an infrastructure side, if you are on the application side, then your audience would continue to remain the same from the SaaS perspective, right? What is happening in the terms of PLG is that even though you are going enterprise or top down, you need to have a PLG strategy. The PLG strategy would not be generating revenue immediately through self-service, but one, it's going to build the credibility among your audience and the community, which is going to allow you to close those deals much faster. The way I've seen PLG work is Google ads don't work. Any paid marketing don't work to drive more PLG, because the market is so nascent in terms of driving awareness that they're not yet ready to make a decision to purchase. Like they're not ready. So what works is now, how do you find other ways to drive awareness in the community? One is like, are you hiring DevRels who are actually really good at connecting with the communities, producing the right content so that it's adding value for every AI developer out there, so that they can immediately start using those tools within their day-to-day workflow. The second is, now, how do you think about paid marketing and promote the content or the value add that you are providing to the community? Like banner ads doesn't work. Social, unless it's adding any value, promotion doesn't work. But you need to use your existing content. You need to use your existing assets to do that. And as a thumb of rule, and I'm assuming they would agree, like make all your content free. Like you should never use content as a lead gen strategy. Your content should always be to drive more awareness and drive and build your brand and build your credibility out there in the technical audience.
Hey, Rajan, you should tell that to Gartner and Forrester. All of the content is behind the paid walls.
They're going after a different market, though.
If
So
only we knew someone at Forrester and Gartner.
Yeah, we have someone here on the call as well. By the way, I'm seeing a comment from Laurent. I'm guessing it's a French one. Looks like, maybe let me see if I can understand the question there. Companies who are going after average deal size of below 50K, should they be investing heavily into SDRs and AEs, or should they balance it with maybe realigning their sales team structures and reducing or reassessing their GTM spend? Any thoughts on that? It's probably correlated to the previous question.
I want to be spicy on this too, so leave room for me.
You want to start? You want to lead out?
Yeah, I have rarely seen a deal that was closed by an AE. Prospecting AEs are pretty strong. SEs do all the legwork to make sure that the product actually fits the customer. And your customer service and your technical account managers after the fact are doing all the education, all the onboarding, and all the retention. So, and this is an opinion I put out there. I'm just waiting for that envelope that I'm afraid to open that shows up in my house. I don't see the necessary need for an AE. And I don't see sales management that knows how to train an SDR. They know how to set up their outreach account. They know how to listen to a gong call, but they definitely don't know how to do proper prospecting. They definitely don't know how to do consultative selling. I don't think the dollar value of the deal, a $50,000 deal, unless you have a contract cycle that's like a year, you're in the wrong industry at that point. But a $50,000 deal shouldn't influence how many people are getting paid or what they're getting paid. What should influence that is how you manage and run your team and script your team. Not the sales can't be fixed with tech. I'm gonna make a t-shirt with that one. But yes, sales cannot be fixed with tech.
Yeah, so Laurent, what Peter is trying to say is fire all your AEs, get your SDRs for prospecting, and then have your customer success for onboarding, and boom, you're ready to go. So you can reduce your S&M cost by half.
Yeah, you guaranteed that envelope showing up. That is not what I said, sir, but thank you. Thank you. What I said was management needs to step up, roll up their sleeves, be in the field for a while, and understand what their product is, how to sell it, who their customer is, how to sell it to them, and most importantly, how their customer can find value. And what's funny is these are just PLG principles. It can apply to anything. So
yeah. So, Laurent, I think what you're getting at is absolutely critical. You're saying, let me compare the ACV with the go-to-market motion and see if it makes sense. And you say, hey, I see people selling deals for less than 50 grand and they're loading it up with payroll. Does that make any sense? Yeah, probably not. In fact, there's a level at which you wouldn't want any payroll involved in that deal. Like if I'm selling $100 ACV or a $1,000 ACV, like $100 a month, I might want that to be self-service. I certainly don't want to pay all the humans that you were talking about, Peter. Well, what about a $5,000 ACV? What about a $15,000 ACV? What about a $50,000 ACV? Each of those kind of processes should be tailored to how the customers in that market want to buy and how it's going to work for me economically in terms of unit economics. And I like thinking about each of those as a production line in a factory. And I'm just going to optimize it for what it's intended to do. So my PLG production line is going to turn a lot faster. It's going to churn a lot of people out. It's going to have a lot of velocity. It's going to have a high churn rate, but it's going to have a low cost. Okay, cool. My enterprise production line is going to go slower, but it's going to have a bigger ACV. It's going to have lower attrition, like higher retention, and therefore I put some more humans into it. Because they're going to have questions and they're going to need to be walked through it. But I wouldn't want to compare this one to that one, and I certainly wouldn't want to average them together and then measure my business on average. That ain't going to work.
Yeah. So almost on time, so we'll probably have time for one more question. Do you want to take Laurent's next question around measuring ROI against CAC? Let me actually.
Return on investment, customer acquisition cost, and lifetime value for people that are afraid of acronyms like myself.
Can I have a one-line answer for that?
Do it.
Absolutely, bud.
Screw all CAC, screw all LTV, get the market share, get more funding if you are in AI right now, and generate that.
Grow at all costs. GAC.
No, but all seriousness, I think these metrics are going to haunt you at some point. So even then, even you have the funding, even you have the right product, or even have the right founders, I think finding a way to grow efficiently is always going to work in your favor, especially if you are leading the marketing or sales. And not now, maybe 3 months, 6 months down the line, I think people are going to start thinking about the adoption. And if there is no adoption, they're going to stop the funding irrespective. So I think efficiency is the way to go, even in long term. And concluding, like, I agree with Dave, and I'm assuming that he has the same points to say.
I think that's a mic drop right there.
There you go. Well, we are out of time. Thank you so much. I think there are a couple of great tidbits of learning. I think we should definitely print that T-shirt that Peter was mentioning about. Again, audience, thank you so much. We'll have the webinar posted out. We'll have it on our Substack channel, as well as you'll find the recordings on LinkedIn Live and YouTube. Again, thank you so much for being a great audience. See you next time when we run the next webinar.
Thank you, my friends.
Yeah.
Thank you for coming.
Thank
So
you so
exciting.
much.